Welcome to the Emerson Group Wealth Call for November 2023. My name is Nick Emerson, owner and operator of the Emerson Group Real Estate Professionals, where we specialize in representing income property owners in buying, selling, and reinvesting using the 1031 exchange strategy. Today's call is all about 1031 exchange basics. What is a 1031 exchange? Who's using the 1031 exchange? What are the motivations why an investor might use and perform a 1031 exchange? And then what are the timelines, qualifications, and things that you can do to set yourself up for a successful 1031 exchange? So let's get right into it. What is a 1031 exchange? Well, a 1031 exchange is a swap of like-kind property for the purpose of investment or business use. In other words, a transaction which permits an investor to defer the payment of capital gains by exchanging real property for like-kind real property of equal or greater value. Now, I really want to touch on like-kind. There's a lot of confusion sometimes about what that means and how you qualify. Well, like-kind is not exchanging a detached property for a detached property, or a condo for a condo, or a triplex for a triplex. Like-kind is merely about the function of the asset, meaning is the asset used for productive use, for income or business use, and is a property that you're reinvesting into also used for investment or business use. As long as you're able to create that connection and swap between the two, odds are there's an opportunity that that asset or tenant in common or fund will qualify for a 1031 exchange. So as you can see, it's really important that we're focusing on the function rather than the form, right? Rather than comparing the type of asset, condo, detached home, multifamily, commercial. Again, it's about the function in which it operates. Define qualified property for a 1031 exchange. Well, as I said, it's got to be held for productive use in trade or business. And real property can be comprised of a mixture of things. Real property is comprised of land, improvements made to land, unseparated natural resources originated directly above or below the land, and can also include certain types of leasehold interest and easements. So an example of some of these might be oil, gas, and mineral rights. There's an opportunity for you to exchange your detached home into a holding within gas, oil, and mineral rights. We have a great relationship in the Texas area, if that's something you want to look into. Now, getting more into what doesn't qualify for a 1031 exchange. Well, in 2018, January 1st, the IRS ruled that personal property or intangible property, such as machinery, equipment, vehicles, artwork, stocks, collectibles, patents, well, these don't qualify anymore. And secondly, your primary residence does not qualify for a 1031 exchange. It's a very common question we get, and ultimately your property is not used for income or business use. Now, could there be some exceptions? Of course, there's always exceptions. And if that's something you want to look more into, there certainly is some options to consider. But at a standard level here, understand that your primary residence is not something that the IRS will honor for a 1031 exchange. However, as your primary residence, you are entitled to $250,000 if single for capital gain exclusion, or $500,000 if married. So you do realize some savings just by occupying your property. Now let's get into what can you exchange into. As I said before, focusing on the investment or business use function of it, as you can see on this page here, there is a multitude of options for you to choose from. You could be looking at detached home, a quadplex, an apartment building, a commercial strip mall. We even have cell towers, windmills, billboards, or even a solar farm. So there's all kinds of options within the exchange space. What really is important to understand is what is it that you need or you're trying to accomplish, right? What's the goal or objective? And how do we make sure we're finding the appropriate reinvestment strategy and asset type that'll meet your needs now and for the future? All right, 1031 exchange basic overview. So we're talking about timelines, purchase amounts, the structure of it. So to start, I really like to harp on the timelines here, right? There's two critical timelines. There's 45-day identification period, right? So when you sell your relinquished property, let's say you close escrow today. Tomorrow is day one of your 45-day identification period. So during that time period, right, you're finding opportunities to exchange into as your replacement property. The second most important thing is the 180 days, which is essentially you need to close escrow on one of the assets or multitude of assets on your ID sheet within 180 days of closing escrow on your relinquished property. Now, typically the 180 days is not really a point of emphasis or stress, because when we do this the right way, what we're really focusing on is making sure we find the right properties within or before the 45-day period. So when we talk about setting up a successful exchange, it's important that you understand that our process of what we'll look to reinvest into, where that asset might be, and what it might function like, are conversations we're having well in advance of putting your home on the market. So we've already put together a plan and we have a good sense of what the target is before your property hits the market, which means that during the marketing time, during the escrow time, that is also time where we can be shopping, looking for suitable replacement properties. So I like to remind people, although there's a 45-day identification period, we really have a lot more time than that because we're pre-planning months in advance of this, so that you never in a situation where you're calling me days before your 45-day period and you don't know what to do or where to look, right? That's a call I've gotten many times. And that just comes down to not having the right representation, the right information, and the right professional to help guide you and give you the information and really the direction you need to understand what we're looking for and where we're going to find it. Purchase amount. So what's most important with the 1031 exchange is ideally, if you want to avoid or defer all taxes, we're going to be looking for properties that are of the same price or greater. What I mean by that is if you sell your property for $1 million, you're going to be looking for properties that you can reinvest into at $1 million or greater. Now, you can, in fact, do a 1031 exchange and not reinvest all the money. That's called a partial exchange. A lot of people think it's all or nothing. Well, fortunately, it's not all or nothing. So the good news is you can sell your property. Let's say you sell your property for $1 million and you decide that you're going to reinvest into a lower price point and you find two properties that are equivalent of $800,000. Well, in this case, you can go ahead and complete the exchange. However, you're going to be paying taxes on the $200,000 difference, right? You sold for $1 million, you bought for $800, you bought down by $200. So you're going to be paying taxes on that $200 you did not reinvest. So a lot of clients we work with will oftentimes do that, and they'll pull some money out of the transaction, they'll pay taxes on it, but they'll set aside some reserves, and then they'll reinvest the rest of it. So good example of not everyone is looking to reinvest upwards. In some cases, that's not necessarily the goal or the objective, and you can still have a successful 1031 exchange. Now, as we head into the identification rules, there's a total of 3 identification rule options for you. The first one, the most common one, is the 3 property rule, right? We're going to identify 3 assets for reinvestment, of which one or multiple we intend to close on. Now, during your period of time, for 45 days, you can put properties on there, take them off, put new ones on there. As long as you have the final options or property you will purchase on there by day 45, that's what's most important. The next option is a 200% rule. Now, this one typically comes into play when you're dealing with trading or reinvesting in different markets, right? So let's say you sell here in San Diego for $1 million, and you're looking at a market that might have properties with a median price of $400. Well, in that case, you can see where there might be a problem if you only got to list 3 of them. The the total sum would only be equivalent to 1.2. So in this case, for the 200% rule, it allows you to take your sale property for $1 million and identify as many properties that will fit within $2 million of gross value. So that makes a lot more sense for someone who might be shopping in a market where they get to list 6, 7, or 8 properties to fulfill the 200% rule. Now the last one's a 95% rule. This is very, very uncommon. Typically, this is dealing with a large, sophisticated portfolio. Another 95% rule essentially means that you can list as many properties as you want on your identification. However, you must acquire and close escrow on 95% of that value. So if I'm identifying $10 million worth of property, I need to make sure to qualify under that rule that I invest into $9.5 million worth of assets. Again, not very common. The 3 property rule is typically the most common, followed by the 200% rule. All right, what taxes am I able to defer? This is the part we all love because we get to listen to all the money we saved and got to reinvest to help continue building wealth for us that otherwise would have gone to Uncle Sam and the IRS. So when you're looking at what taxes you're able to defer, we want to start with the capital gains, which depending on which income bracket you're in, that can be 15% or 20%. The next thing is going to be the income tax. Here in the state of California, your income tax can range anywhere from 8.84% to 15.8%. Now, an individual is currently taxed at 12.3%. So on top of your federal and your state, depending on your adjusted gross income, you might also be looking at the healthcare tax for 3.8% if your adjusted gross income is in excess of $200,000, or if you're married and in excess of $250,000. Now the last one, depreciation recapture. This is a huge one. A lot of times people aren't aware of this or understand how it works. And depreciation recapture comes in at 25%. So let's just say hypothetically, you bought a property 30 years ago and you've been depreciating that asset, right? Over the past 27 and a half years is the depreciation schedule for residential. If you were to sell that property and not reinvest using a 1031 exchange, you're going to be subject to paying back 25% of the entire depreciation table that you wrote off throughout the life of that asset. Essentially, the IRS wants some of their money back because they've been giving you a benefit every year for the past 27 and a half years. And since you're no longer going to be owning that asset, right, they want to cash in and make sure they're getting a portion of that savings that they initially offered you in the first 27 and a half years. So if you add all these up, 15, 20% for capital gains, let's say you're individual in California, 12%, coupled with the depreciation recapture, we could be looking at taxes in excess of 40% of the total sale money. Now, I don't know about you, but I don't think anyone wants to give away 40% to anyone. So that's exactly why we love the 1031 exchange. We have code that was built in from the IRS to help us protect our wealth, build more of it, and make sure that that gets passed on to our family when planned right, without having to pay taxes to the state of California or the federal government. Congratulations, because that is one of the huge things a lot of people are doing 1031 exchange for. They don't want to pay taxes to their state or the government, but they do want to continue to invest and build wealth for themselves and their families. While we're on the topic of taxes, I also wanted to share with you what the withholding form for the state of California looks like. It's known as Form 593. So this would be what you'd be looking at with your escrow when you're going to sell your property. As you can see, there's a multitude of options you might choose from as far as individual, trust, partnership, corporation. So one of the options available to you is that you can itemize and do a computation to figure out what your tax is for the state of California. Or there's another option, which is the flat tax, right? You'll see for 3.33% times the gross sale price. However, because you're doing a 1031 exchange, neither of these will apply to you, because what you'll be doing is checking the box that you are exempt and no withholding will occur. So congratulations. You don't need to worry about this stuff unless, of course, you have a taxable gain and are not using a 1031 exchange. 1031 exchange motivations. What are the reasons why investors use the 1031 exchange strategy? Well, most people might think that the main reason they use it is to avoid taxes, which, yeah, you're right. A lot of people do use 1031 exchange for that. However, I think what you're going to find is there's a lot of reasons why people use a 1031 exchange, of which taxes is a reason, but it's not the full picture of why someone might be taking advantage of using the 1031 exchange. So let's go through these. If we're looking here at the graph, we'll start with cash flow, right? You're looking to improve your cash flow position. So maybe looking to sell vacant land, sell a property that has a lot of repair issues or is really low in rent, right? And then being able to reinvest that into a location that has better cash flow or better leverage, right? There's a lot of assets that make a lot of sense when you first purchase them, but over the course of time, we know there can be a regression in the overall return on your investment and the return you're getting on your equity. So cash flow is certainly one why people would want to reinvest and improve their monthly income. The next one we're going to look at is depreciation. As I mentioned, if you've owned your asset for 27.5 years or greater, you no longer have a depreciation table. In that case, you don't have that write-off, so your overall net money in your pocket is going to be less. There's a regression on that. So we need to be paying attention more of a holistic approach to our investments. Because as you can see here, a lot of people probably won't even think about depreciation as being a cash flow benefit. Yet it is when you get to pair it with your income. Also, another reason might be if you're using some of the more sophisticated options for accelerated depreciation, right? There's some cases, myself actually just did this with Joe Vieri, and we're able to do a cost segregation, which is a accelerated depreciation table. So essentially, I was able to itemize the building components of the asset I own, and I was able to manipulate the timeline in which I depreciate certain components. So structural versus non-structural, all those come with a different potential option for you for a 5-year write-off, 10-year write-off, 15 or 30. A lot of people might be looking to 1031 exchange and use this approach to offset their income and therefore save tens of thousands of dollars on taxes. It's almost like looking at it like a reverse cash flow, right? You're saving money on taxes, which is the same thing as earning money because you have the money in your bank account and it's less getting taken away. So there's a lot of space in the depreciation category. And if you're curious more about what kind of options might be available to you, we can certainly go over those on a call. The next one's appreciation. So really just using the marketplace to understand what is my current investment strategy, what's my time horizon, and recognize that those things change over the course of time. So you might have started your investment journey in looking solely at properties that are appreciation based, right? They might have a low cash flow or a break even, but you knew that long term it was going to be a great asset to own and the values were going to support that. However, as you get older, looking for opportunities for appreciation might no longer be your motivation. You might be looking more for cash flow, right? We want to insulate our retirement income and make sure we're getting as much money as possible off of our investments. So understand that appreciation, cash flow, these things all vary depending on where you're at in the season of investing. Next one's conversion, right? We love this one. We'll talk a little bit more about this on one of the coming slides here. This is your ability to convert your retirement or second home into a rental property, or the even better option is the opposite, converting your rental or investment property into your second home or forever home. That is written into code by the IRS and is certainly an option available to you. So we'll be sure to go over that. Consolidate and diversify. So if I own multiple assets in several different locations, let's say I have a single family home here in San Diego, one in Texas, and a few more in Alabama. Well, over time, right, that can get noisy or time consuming. So we've got multiple property managers. We've got multiple roofs, repair needs, and all that ultimately is going to cost you time and money. So consolidation would be an option where you can sell those properties and reinvest into one larger asset. Case might be of taking these detached homes and reinvesting into an apartment building. The benefit of that is really you are able to offset your cost structure, meaning you have an economies of scale, right? You have one roof instead of 4. You have one plumbing system instead of 4. You have one foundation instead of 4. There's a lot of costs that you're likely to be able to control in a better, more efficient manner, knowing it's only one asset. Additionally, you're only going to have one management company. So instead of getting 4 different emails from 4 different management companies for your statements each month and at the end of the year, you're only going to be dealing with one entity. So a lot of people see value in that because not only do they allow themselves to concentrate their investments into one location, they also are able to mitigate their operating expenses, and then they're also able to save time by not dealing with as many people, vendors, managers, lenders, what have you, for each property. Also diversify, of course. If you have an asset or assets in one location, diversifying might look like reinvesting into a different market or location, or maybe a different type of asset, right? Instead of brick and mortar, maybe you're looking at putting something into more of a passive fund where you know it's not going to be as high, but it's going to be consistent and it's not going to require any time or effort on your part. So again, consolidation or diversification. Other one would be reduce management burdens, which we touched on a little bit, but this might be taking your properties or property and reinvesting it into a fund or a Delaware statutory trust, right? Or a couple other options of private funding as well. In that, you're ultimately taking your brick and mortar asset, converting it into a fractional ownership percentage, and therefore you won't be dealing with managers, property managers, or anything to do with the property or the properties in that fund. You'll essentially be collecting a check each month, and some people prefer that simplicity over dealing with tenants, toilets, and trash. Next option, estate planning. Now, this is a huge one. Given the current climate of our population and demographics for age, we are looking at one of the largest or the largest transfer of real estate wealth in the history. And what I'm talking about is baby boomer age bracket. Baby boomers consist of $13 trillion worth of residential assets or real estate assets here in the United States. Over the next 20 years, we're going to see that $13 trillion transfer over to their siblings, heirs, what have you. A lot of people aren't prepared for that or have a plan or have even talked about what that would look like. So I want to make sure estate planning is huge, because what we're doing here with the conversations, the planning, and the education is that we're allowing people to put together estate parts, pieces, and components that they can perfect and do now, right? Rather than lead into a family dispute where no one knows who gets what or what's going to happen, it's having an active conversation about where your kids are located, how they would want to participate in owning real estate if they do, and figuring out what your options are and plan might be to put in place now, where you can ultimately bless your kids by allowing them an opportunity to invest or assume a property that will be in close proximity to them, something they could even help work with you to pick out. Who wouldn't want to do that and enjoy the benefit of seeing that rather than not? So estate planning is huge. Are you looking to simplify, whether that's geographically, whether that's the structure of the assets you have? There's a lot of categories within the estate planning as far as what you might want to do, as far as bringing it out and reinvesting to a multitude of siblings, or maybe it's consolidating it into one passive fund so that that can ultimately be inherited and then re-split up and redeployed as the beneficiaries choose. Again, a lot of options in here, but having these conversations now, well, I can assure you, are a lot better than after the fact, when the kids all have different options, all have different opinions, and not all of them want to own real estate. So understand that you have a tremendous opportunity to speak about this, put together a plan now, rather than waiting after the fact. Lastly, use in profession. So if you're looking at a doctor, a dentist, or something where you have a physical brick and mortar space, this could be a tremendous opportunity for you to sell income property, reinvest into something that you could otherwise occupy for your business. Example, as a real estate broker, I have an option to purchase a mixed use space where I have an office and then I have units behind. There's so many tax benefits to be had with converting this into something you can use for your profession. So as you can see, we covered a lot of reasons why people conduct a 1031 exchange. These aren't all the reasons, but these are a lot of the reasons why investors choose to take advantage of the 1031 exchange. My question to you is, which one of these motivators fits your wants and needs, and what will you do with it? Buying your dream home using the 1031 exchange strategy. This is a tremendous opportunity for you to convert your rental property into a second home or forever home, or convert your second home or vacation into a rental property. So for those that are tired of dealing with toilets, tenants, and trash and are looking to convert that into something they can use and enjoy the benefits of it long term, this is for you. The IRS specifically wrote this into code in 2008, where you have the chance to mitigate, defer all taxes, buy a property that you will eventually move into and enjoy as your second home long term. Now, of course, there's some rules, and here's how it works. First important aspect is making sure that when you buy your replacement property, the property is rented out for a minimum of 14 days each year at fair market value. Secondly, you cannot own or occupy the property for greater than 10% of the amount of time you rent it out, or less than 14 days out of the year. In doing that, you're able to qualify your property to move in after 2 years. So again, this is an opportunity for you to essentially defer or pass on no tax implications for an asset you otherwise would have had to sell and pay over 40% in taxes. It's huge. So let me give you an example, a real life example of how someone that we helped out was able to take advantage of this. Guy and Amy lived in Colorado at the time, and they had parcels of land that they wanted to sell. They had owned them for a long period of time. They weren't generating any cash flow naturally because it's vacant land. They were able to sell 3 parcels of land there, use the proceeds to reinvest and buy a property in Fallbrook with a pool, tremendous views, secluded, some acreage, something that they get to move into and enjoy and be closer to their kids and grandkids, right? So just think about that. They took non-productive land, dirt, kind of expensive dirt too, and converted it into an asset that they get to enjoy for themselves without paying any taxes to the state or the federal government for that exchange. And this is all written into code, so this isn't a secret, right? The IRS put this into provisions in 2008 so that we could follow it. So again, tremendous opportunity. If you want to learn more about that or talk about a strategy to help you guys convert one of your properties into something you can enjoy, those are some of the best opportunities out there for us. So great opportunity for buying dream home. And now let's look into another caveat of the exchange, which is the reverse exchange, right? We all know the 1031 exchange is selling your property and buying another property. Well, the reverse exchange is the opposite. Rather than sell first, you actually buy first. Now, understand that the reverse exchange is a little more complicated and is more costly. Yet, the reason why people would use a reverse exchange is a couple things. One, you have a phenomenal opportunity that presented itself, and that opportunity has to be taken advantage of. So rather than let it go by the wayside, you're able to buy that property and sell one of your rental properties to fund it. Now, a couple caveats with that. Obviously, you have to have cash or the ability to buy the property first without selling your property. So in some cases, that can eliminate a lot of people in that category. Additionally, you can't have title to both properties at the same time. So what will happen is before you close on your purchase, the 1031 exchange company will need to take title to your other relinquished property. Therefore, at no point do you have your name ownership on both the properties. That makes sense. Additionally, this might be a great strategy to use in a market with low inventory. If you know options are really hard to come by and they're few and far between, buying the opportunity first ensures you don't run into a time sensitivity issue that might disqualify you, right? The buying part is typically the more challenging aspect of the exchange. So to be able to buy first, then sell, really puts you in the driver's seat to be in control of the transaction and know that you're not going to run into some of the concerns or issues or stress that a traditional exchange might operate under. Now, again, this is a very detailed process. So if you have more questions about it or would like to learn more, we're happy to connect you with our 1031 exchange partners with Steve Decker and Jordan Phillips. Now, we have covered a lot of information on the 1031 exchange. I trust that you'll be able to take away some ahas, some new information that will enable you to consider options and take action where appropriate. So if you have any follow-up questions, we didn't answer something about your particular scenario, go ahead and send them a message. We're happy to help you understand what might be available to you or options for planning long-term for whatever reasons or motivations you might have. Lastly, how can we help? I want to just share, of course, if you want to schedule a call to go over what exchange options might be for you, you'd like to discuss an appointment for long-term planning for your estate or for your portfolio, or maybe you just want to go through a specific scenario and learn more about what options might exist. Additionally, if you'd like to request an asset performance test, it's a way where we can help analyze your current rental performance and understand how it's performing relative to other market opportunities today. Property management services. We have an independent property management company by the name of Leisure Life Property Management. If you're interested in getting a free market analysis or having a walkthrough done at your property to learn more about deficiencies and opportunities to improve your rental property, click on the link for the third one. And lastly, if you're interested in checking out past wealth calls or ones we might have coming up, click on the bottom link. We'd be happy to share those with you. Looking ahead to December, I want to share we're going to be doing our wealth call on December 28th. We're going to be going over where we were this year, what was it look like, what was a recap, what are the market trends, some of the ahas, and kind of what are the expectations heading into 2024. So I'm really going to dive into some really neat trends, show you some cool data points, and really get a good snapshot of what happened this year, where were we at in January compared to December, and ultimately, what does all this mean for looking ahead in 2024? Outside of that, I trust you guys have gotten some value out of this call. If you know anyone else who might benefit from this, feel free to share with them, and we look forward to seeing you on our next wealth call in December. Take care.